Good afternoon, ladies and gentlemen. Asked to talk about the future cost of natural gas. I think what you have to do is you have to look at a multitude of factors. You have to look at a multitude of more and less important factors, and you have to look at the multitude of more and less important factors for the short, mid, and for the long-term period. And that's what I'm going to try to do within the next 10 or 15 minutes. I will do a very comprehensive run-up through the factors which are defining the costs, or better to say the price of oil and gas now, or the past, now, and in the future. But let's start with, let's see, get this running. Let's start with where we are at the moment. What you see here are oil price developments as of yesterday or the day before. The interesting thing here are the two lines you can see here, which is the 12-month moving average for Brent prices, one's nominated in dollars and one nominated in euros. Two interesting factors in that I want to start off, or actually three. Number one, we are at record highs. Yeah, we are, if you look at the very end, we are even higher in dollar as well as in euro nominations, higher on a 12-month basis, 12-month average basis than in the year 2008, where we're seeing $150 oil. Yeah, one of the reasons why our petrol stations are charging us so much at the moment. Number two, what you also see here, that the volatility to a certain extent in the oil market has been reduced. You can see it by just looking at the chart that we are moving relatively flat, but you can also see it if you want to look at all various of different volatility indicators and index which are out there in the industry you can look at. Yeah? So the interest to a certain extent from the financial markets in trading up and down the price is reduced because a trader likes big volatility because that's where he makes money. The financial investor, the trader likes that. Yeah. But now the question is, what is driving these oil prices now and in the future, basically? Yeah. And again, you have to distinguish between different time periods. In the very short time, if you look at intraday, even intra-minute movements of oil prices, you will clearly see that it is the financial markets, it's the investors, it's the speculators, a matter of definition, what you'd like to call them, which are defining the price of oil. Yeah. And what you see here is basically the development on crude traded on NYMEX and ICE. For those of you who don't know, NYMEX and ICE are the two biggest energy exchanges worldwide, one in London, the other one in the US, basically. And what they tell you, just by purely looking at the volume traded, that they have been increasing over the last decades and are, in general, on record highs, particularly ICE. Yeah. It also tells you that this unit is 600,000 lots. One lot is about 1,000 barrels. So you can estimate the size of what we're talking about, what the financial markets are trading at the moment in terms of oil. But the interesting factor as well is that there has been a change this year. These are year-to-date numbers. So at least on NYMEX, we see decreased interest from the financial markets on trading crude oil. This has various reasons, and I'm happy to discuss this in the following. I don't want to go into all of them in detail, but one of them is that there's supposed to be, or there could be seen a change in investment into commodity futures for the next year, 2-3 years. Yeah, we've seen now, since at least the beginning of the year, that the return on your investment when you invest in commodity futures has gone down. And these pension funds who are long only passive investors in oil, their returns on investment were not good. Yeah, so there is, out of many reasons, there is of course for NYMEX the distortion in the US market, I'm coming to that, and several other factors in terms of regulation which are causing this return, but one of them can be also seen that there might be a decreased interest in trading commodity futures. Good, but what is the financial market looking at when it does its decision? Yeah, one of the key factors is, of course, economic indicators. You can have multiple. The most popular at the moment are the so-called PMIs. My colleagues don't like them that much. That was why I was not allowed to bring them here. But one very good indicator is the OECD Composite Leading Indicator. It's a forward-looking indicator which tells you turning points in economies. Okay, and it would have told you at the beginning of 2008 that there was a downturn observable already beginning 2008, which we then have experienced by the end of 2008. Yeah. So what we're looking at this here is turning points in the industries for, I mean, we have taken here several countries. The message of this chart is that we're moving sideways, and it's not very clear where we're moving. Yeah, and this is exactly one of the questions the oil market is facing at the moment. Where is the economy heading to? Yesterday, I think we had a sell-off or reduction in oil prices by about, I think, $3.5, and the reasons quoted were basically Spain, fear of another Greece, and also China, arguing that China has said that their stimulus package are probably not as big as everybody expected it to be. So these two reasons caused oil prices to fall by 3%, or roughly 3%. Yeah. So these are economic factors, are one of the most important factors for the time being in the short term, but also more for the long-term period. Of course, always, if you do long-term analysis more than, you would look at supply-demand. I'm just showing you here our balance, and I'm just basically telling you that when we look at the developments in supply-demand, we would see a relatively unexciting development. So we see only small increases in the requirement for the industry to produce more oil. Yeah, and along the lines of what Olivier said before, I would say that it's not a question of peak supply, along what Mr. Hubbard said, but it's a question of peak demand. Yeah, regulated by the price, what we're paying, and what we're willing to pay for the energy we're using. But within this development, within these bars, basically, there are two interesting developments. One, on the supply side, you can see that the share of OPEC increases in total supply production on the supply side. On the demand side, this bluish line basically tells you that the share of OECD demand is decreasing, and the demand center, the growth centers for demand are moving to the non-OECD region, which is basically China and India. If you put this very bluntly on one chart, what you see here is exactly what I'm telling you. Growth regions, non-OECD, Middle East, Central South America, Africa. Declining regions, particularly North America, OECD, Asia. Yeah? And the Americans haven't figured out yet, as of yet, that within the next 5 years, the demand for gasoline, mainly due to efficiency reasons, will be falling by some 700,000, 800,000 barrels a day. Yeah, only in 5 years' time. And this will change. On the good side for the oil industry is basically that you have China, who is probably increasing the demand over the next 5 years by some 2 million barrels per day, which will cope for the fall of United States, Germany, France, and the UK in total. Yeah. But what is the important thing when you look at this is the change of the structure in oil markets. Yeah, and the change of the structure from non-OECD or from OECD into non-OECD demand regions. And what is causing, and this is also one important thing we should discuss in more detail, is the consolidation process. What you see here is a map of European refiners basically either being forced to close down or being forced to sell off or being forced to reduce the capacity in runs. Yeah, you can see they're selling it to Russia, they're selling it to Asian buyers, they're closing down volumes, and they're capacity downsizing purely because the demand in Europe is not there anymore, but the demand in Asia will be there. And in Asia, you will see a lot of new refiners being built up, but this is causing massive problems for the European refining sector at the very end, because they're operating in a very low margin environment. And only today, there was again further news. I mean, it's a daily exercise to update this chart at the very end. Only today, there was a news that Ingolstadt was now sold to Gunvor, one of the big oil traders. Yeah, a second refinery sold to Gunvor. So you see a change in the structure of the oil industry, basically. Then, when you talk about oil prices, you always have to talk about geopolitical risk. A little bit in line with what Olivier was saying before there. I don't want to go into detail about Iran, Saudi Arabia. I'm happy to discuss this. It's a very interesting topic, right? But I think the basic message is there is a geopolitical risk premium in oil prices, and it's predominant in the Brent price. Yeah, and it's something which will come up and go away again. Yeah, but it's very much related to, I wouldn't say the MENA region. I would call them the rentier states. I don't know if who of you are familiar with the rentier system, but it's basically those countries which is a very specific socio-political system which is paid on unearned income, meaning rents. Yeah? This can be selling of crude, but this can also be, for example, receiving foreign aid. They have a very specific political system. Yeah? And this very specific political system leads to one very critical factor, which is, I would say, IOCs at the moment are facing, which is, if I'm an IOC, an international oil corporation, where do I invest in upstream? And the decision they're making, very broadly speaking, is, do I accept geopolitical risk or do I prefer technical risk? What I mean is here, do I want to invest in a country like Somalia, even though I know there are the resources are there, but I know that the geopolitical situation is very difficult, or do I go to regions where I have a higher technological risk, which I probably can better handle? And yes, you can see on a daily basis as well. I mean, one of the best decisions or best issues was here highlighted by Statoil about 2 or 3 months ago, where they're basically saying, I'm going out of Iraq, of a West Corner project, Iraq, one of the most prosperous regions when it comes to oil supply, but at the same time, on the same day, they were announcing that they're heavily investing into shale oil in the US. Yeah? So basically, IOCs are moving away from this geopolitical risk, which they cannot control at all, towards region with higher technical risk, which probably also causes, we have to see that, or also a lower margin environment. That's also in line with what Olivier was saying, because the costs are just simply higher. But you can better predict your risk profile in this respect. And what you see here is basically, for some of them you might be familiar, that's leaned on one of the famous charts of the IEA, which shows you, on the one hand, the reserves estimate, on the other hand, the production costs for the respective estimates. What we have done differently in the IEA, we have only been taking the volumes which we see are realistic to be produced over the next 30 years, because the IEA just takes everything in that pot. Yeah, they also take GTL, CTL, and all these exotic technologies in that pot. And what you see basically is that the development will be that IOCs will be pushed towards this very right hand of the chart. Yeah, and that's what you see. You see, as I said, a lot of investment in shale oil. I'm coming to that. You see, for example, Russia, the ultra deep water Arctic developments, Brazil, all these developments are very clearly showing you that IOCs are moving in that direction. Versus you have the cheap oil, if you want, still in the MENA region, difficult to access very often due to geopolitical risk. Now, talking about shale oil, very briefly, I think you have been coping with this yesterday, but I just want to comment a very specific point. This is the US crude production outlook. The black line gives you the total volumes, and this does not very much look like the Hubbard curve, yeah, the peak oil curve. It's moving up here again at the very end, and this is mainly to the shale oil developments, and you can see the rapid development in shale oil developments, in this only case in North Dakota. I'm not saying that shale oil will be the future of oil supply. What I'm saying is that shale oil is another factor which increases the uncertainty in the industry. Yeah? If you look at only for the US, what the different forecasting agencies are telling you what the shale oil output will look like in the next 8 to 10 years, you can see a discrepancy from, by 2020, shortly above 1 million to, I don't know where this is going to end up, 5, 6, 7, 8 million barrels per day of oil production, only in the US. Yeah? And basically you can consider this to be your area of risk within there. I mean, we are very much on the conservative side. If you're interested, I can tell you the various reasons why. One of them being the technological aspect, not so much the environmental, but also the technological aspect. But this is very much an uncertainty factor you're facing in the industry. And last but not least, and then I'm hopefully anyway not much longer than 10 minutes, and I'm hope for open discussion, all the points I'm very briefly raised here, is when you talk about oil price developments, is also what I called here strategic considerations. You probably can also call it political considerations, but I want to be a little bit more diplomatic. What I mean here is oil prices are, to a lot, also defined about the decisions politicians, strategic decisions politicians are doing. One, fuel subsidies. Yeah. Middle East, Asia, these are all heavily subsidized countries on their fuel. So, of course, the demand growth is big, but they cannot reduce the subsidy they have on the fuel due to public disagreement. Let's put it like this. Yeah, and they're very much a discussion what they're going to subsidize, food or fuel. It's a different food versus fuel debate. We're into that. Yeah. On the other hand, I put here the question of Iran for a specific reason. I mean, again, very political reason. I'm happy to discuss it after that, but I just want to bring two specific issues with that in terms of strategic consideration. Number one, it's a strategic consideration to sanction Iran. And everybody within the European Union, the US, knew what the implications are or will be. Yeah. So this is the number one. And how you treat Iran and what you announce to the public is a marketing campaign which is defining the price. So if the FBI or CIA are announcing news that they don't know where the nuclear facilities are in Iran and there is no way that could be a military attack on Iran, that's of course a marketing campaign to push down prices. And that's what we have seen. Yeah. And there are various occasions. There is Saudi Arabia talking about they will supply to the market whatever they want. There is all kinds of different announcements in order to define or to control or to market for low oil prices if it is needed. Yeah. Number two, in terms of strategic consideration, which is also a little side note I want to bring here, is when the G8 meet, and I think they did that for a month ago or so, and then during the meeting are saying we're still discussing the release of strategic reserves worldwide. Yeah, in a time where evidently the market is oversupplied, when they're discussing to release additional volumes, that's of course a strategic decision to make such a statement. Yeah, and it of course has an effect on the market. Yeah. And then last but not least, I love this example of the US, and to a certain extent I want to challenge Olivier's chart where he was basically showing us the control over resources. Yeah? And I would actually disagree, or to some extent challenge you on the US. I would actually basically tell you that the US is very much controlling the natural resources at the moment, in difference to what your chart basically says. Because what they're doing is they're not allowing for exports of the natural resources, may it be oil or gas. I mean, they have some basic allowances, but overall, they're not allowed to export oil and gas, yeah, produced in the US. And what it leads to, given the fact that they have massive overcapacity or massive supply additions due to shale oil, is a distressed pricing. Yeah, you have sometimes $30, $40 within the middle of the US, lower prices than you would see international prices. Yeah, what it creates in the oil market, on the one hand, is, and I would call it artificial subsidy. Yeah? What it also creates on the natural gas side, and you see here our forecast basically for the different regions. This is Asia and Europe basically, and here on the very bottom, that's the forecast for natural gas over the next 10 years for natural gas in the US. It also creates, and with this I want to stop, a strategic advantage versus competitors. We see already now that a lot of industries, may it be the petrochemical industry, may it be steel industry, so all kinds of industries which are heavily feedstock dependent on natural gas, moving into the US because it's cheap there. And it's only cheap there because the US is not allowed to export the volumes. Yeah, because as soon as they would open the market would adjust to international market prices, whatever that is in natural gas. It's a different discussion. So if you want to bring it to the extreme, you could even argue that the US is profiting to a certain extent from high oil prices. On the one hand, because they have a domestic subsidy on the domestic prices for their domestic refining system. On the other hand, in terms of natural gas, most natural gas prices globally are defined by oil prices. So they will move with high oil prices, natural gas prices will move up. So the higher oil prices are, the bigger is the competitive advantage the US have with their low natural gas prices. Yeah? And with this kind of strategic consideration at the very end, I thank you for your attention and hope to answer your question afterwards. Thank you very much.